Hi, I'm Pattu from freefincal. Today let's talk about an interesting question asked by a member of Facebook group Asan Ideas for Wealth. Suppose I have 100 rupees and I'm a highly risk averse individual and want 8% return year on year in the current economy. What are the options available? My investment horizon is 5 years. So, whenever you see a question like that, the first thing that you want to ask is if the person's serious about the answer to it, and the person said he was. So I went on to answer him, and this is basically my answer. So if a person says their investment horizon is 10 years or 15 years and say they don't want any kind of risks, then you have to talk to them about inflation, about loss of purchasing power over the long term, why a pension is wrong, is not a good idea in after retirement, and so long, and that kind of standard advice we have talked about 100 times. But in the present case, the investor says that the horizon is only 5 years. So, in that case, over 5 years, inflation is not that big a deal. Inflation will be there, but it's not that big a deal. So, you don't need to actually go on and fight it. So, right there, you can tell the investor, look, you don't need to take the pains of 8% returns over 5 years. You can just get on with what you have with respect to a simple FD from a good bank like SBI and so on. The question is it possible, even theoretically, is it possible to get that much high return in the current economy, or in general speaking? So it's very easy to be dismissive about it, but let's not be dismissive about it and actually look at how investment returns vary when the investment risk increases. So this is a very rough schematic. This is not how it actually works. The investment return versus risk for different asset classes does not look like this, but I prefer this kind of a equation because it helps me convey a simple point. This graph, I'm not sure if anybody anybody who likes plotting graphs, can you guess what kind of graph gives you, what kind of equation gives you a graph which looks like that, which kind of looks like a sine wave, but is kind of increasing in amplitude as it goes from left to right. So in this graph, you have investment risk increasing in the horizontal axis, investment return increasing in the vertical axis. The little green dot here, let's call that as the risk-free return. There is absolutely no risk in the investment, and that's a guaranteed return. Now, as you increase the investment risk from left to right, you can see that the potential return starts oscillating. So that's what happens when you take on investment risk. The return possible starts fluctuating. It can be below the green dot, above the green dot, and as you increase the risk, it starts fluctuating more and more. But before we move on any further, I want to clarify that the risk that we are talking about here is the visible risk, or what is known as the volatility. That is the price fluctuating up and down for a share or a bond that you see in the markets every day. However, that's not all all there is to risk. There are many invisible risks, and I just did a video on the invisible risks associated with mutual funds or any kind of investment. One of them is, of course, the credit risk, because you can't quantify credit risk. Suddenly, the credit rating will change, and the value of the bond will fall down if the credit rating drops. And then there is something known as reinvestment risk. For example, your investment horizon is 10 years and you put a FD for 5 years. For 5 years, the return was 7%. After 5 years, if you want to reinvest again in an FD, the return is only about, let's say, 4.5% or something like that. It's lower return. That is, when you reinvest the money, you are reinvesting at a lower return, and that's called as reinvestment risk. So those are risks which are invisible risks, which you can't simply quantify using the standard deviation and so on. So this risk that you see here is basically the visible risk. So we must first tell the person who is asking for investment options whether they understand the visible risks and invisible risks, and when they say they are risk averse, it should mean that no kind of risk is allowed. So that much we have to be very clear about. Now, you have to take on risk when your investment horizon is large. I will talk about that probably in another video. But if your investment horizon is large, you must take the chance of getting a return greater than this green dot, and also face the prospect of getting a return lower than this green dot over the long term. And that's a you have to try and take advantage of the available opportunities. There is no other way about it. But for a 5-year horizon, you can pretty much stay at this end, and you can even ask, is there any investment today that will give me 8% return? That's basically sitting on the green dot. Can I get 8% return? So let's first ask, what are the choices when I'm sitting on the green dot? Basically the guaranteed return. There is no visible risk, there is no invisible risk. Then obvious choices are, you can invest in a Government of India bond for 5 years, you can invest in an RBI bond for 5 years whenever they are available. You can invest in post office time deposits for 5 years. These are instruments that come with absolute sovereign guarantee. That is, this is the last thing that you expect in the country to fail. Even if SBI fails, these should not fail. So that's what I mean. Of course, banks like SBI, ICICI, HDFC, they will not fail because the RBI themselves have declared that these banks are essential to the country and they are too big to fail. So somehow the government will ensure that SBI and these banks will stay afloat. In fact, if I'm not wrong, when SBI got into trouble, it was HDFC or ICICI which bailed it out with some kind of money and so on. If sometime recently, I'm not very, my history is very poor. Then you have the state government owned corporations like Tamil Nadu Power Finance and so on. Everybody thinks they are absolutely free, free of risk, guaranteed and so on. But the point is that they can delay interest payment if they take on too much of debt. Then and their profitability is low, then they may have to basically borrow from the government, from the state government, and do it. See, if you are a power finance corporation, their problem is they invest only in the Tamil Nadu Electricity Board, and they are not diversifying. And therefore, if the electricity board runs into loss, which is very likely and possible, then they have to borrow only from the government and so on. There could be delays in interest payment, just like the EPF has problems. Then you have the AAA rated corporate bonds, FDs and so on. Again, there is a concentration risk here because any day profitability can be affected and the rating can go down. So there is always some kind of risk. Then come the market linked products like overnight funds, liquid funds. I would say, in my opinion, these have significantly, the concentration risk is practically significantly lowered, at least if not zero. It's significantly lowered in these funds, and the market risk is very less. Although you may get lower returns, there's a possibility of the reinvestment risk is very large in liquid funds and overnight funds. For example, so they may give you 7% returns, and then if the interest rates go down, they will start giving you 5% or 6%. But if the interest rates go up, they can give you 8%, 9%. So that kind of reinvestment risk is very high in market linked products. But I would say, because the concentration risk is lower, I would say that's actually not a bad deal. But then that's only for people who can take on some risks. So the other problem is that if you look at financial advisors, they will tell you, oh, your investment horizon is 5 years, then you must invest in a debt mutual fund that has got an average maturity of about 5 years. This is just garbage advice. If you invest in a debt mutual fund with average maturity of 5 years in the portfolio, which means some bonds can be of longer maturity, then the NAV will fluctuate significantly because of demand and supply movements in the market. So you never ever match your investment profile, investment horizon with the maturity profile of the debt mutual fund. It is just garbage advice that is found in textbooks till today. So obviously there is always going to be some kind of risk somewhere. If you say there is no risk, then if you don't want any risk, then you have to basically settle for a low return. But the point I want to really make in this video is that green dot that you saw in the previous graph, in the previous schematic, that will basically over several years, over the course of 10 years, 15 years, 20 years, it will gradually go down. It will oscillate because if you start from here, at some point it will be here, at some point it will be here, some point it will go up. It will oscillate, but it will gradually, over the course of 10, 15 years, it will gradually go down. And if you actually look at the post office deposits, 5-year term deposits, at the start of the last decade, in 2010-11, I would say, it was 8.5% 5-year term deposit from a post office with absolute sovereign guarantee. Today it's 6.7%. So that's a good thing. The country has developed, the rate of borrowing of the government has come down. Government debt will slowly come down over time because they are borrowing money to, and they are investing in many initiatives. If those initiatives start paying off, some of them will over time, then the government borrowing can come down, and their interest rate will also come down, and that's a good thing. There will be short-term inflation issues, and therefore there'll be ups and downs because of the inflation spikes and so on. But gradually, the risk-free return will basically come down over a period of time, and that is something that we have to be aware of. But my suggestion is that over short term, over 5 years or so, please don't chase after corporate deposits. Please don't chase after returns. Even if you understand the risks, don't chase after it. For example, you have this Shriram Transport 5-year FD that's more than 8.5% or so, but it's got a AA plus rating. Now, please recognize that those guys have to get a profit margin much higher than this 8%. For them to be solvent and basically process debt, and even in a normal economy, getting that kind of returns is very hard. And in this kind of situation where they are basically, we don't even know if we are going to get into a lockdown again if the cases increase. So in this kind of uncertain economy, putting money into a corporate deposit, whether they are AA, AAA, whatever rating, it's very dangerous, and it's best not to chase risk. So again, I would say it is obvious to everybody that you can't get that higher return without any risk. But I would say, please don't chase after risk. I see many senior citizens doing it. Don't chase after risk, especially in this kind of economy, because it can backfire. And over the short term, please never chase after risk. There's no need for you. If you want to chase after risk, there must be a goal, and that goal is inflation. Over the long term, yes. Short term, not necessary.